Welcome to our first quarter video update for the year 2023. Today, I have with me my fellow portfolio manager on the private wealth team, Maria Dawes, as well as Paul Carter, senior portfolio manager at Capstone Asset Management. Welcome, Paul, and we're so happy to have you. We do have a lot of questions, and Paul, I know you have a lot to comment on. So without further ado, I would like to ask Maria to kick us off with the first question.
I would be happy to. Thanks, Janet. So, Paul, we had you speak with us a few quarters ago, and so welcome back. It's now been just over half a year since you've joined us. So tell us what you've been up to.
Great. Well, hi, Maria. Hi, Janet. Thanks for having me back. So it's been a fun and exciting 6 months since I last joined you on video here. I'm fortunate to be involved in a number of different areas at Capstone. But I'd say the biggest initiative that I've been working on has been the launch of our new faith-based investment strategy, the Capstone Canadian Equity Income Strategy, which we refer to by its acronym CESIS. CESIS is an active investment strategy focused on high-quality, market-leading Canadian stocks that pay regular and, in many cases, increasing dividends. We also focus on companies whose businesses are being run in a manner that is consistent with Capstone's biblical worldview. So the last several months, I've been focused on really all aspects of launching CESIS, like researching and selecting stocks for the strategy, adding to our investment team, expanding the depth and breadth of our biblically informed overlay company research, and then ultimately investing new client accounts in the strategy. In addition to CESIS, I am responsible for helping to manage our equity pools, specifically the Capstone Traditional Equity Pool and the Capstone Non-Traditional Equity Pool. Most significantly, I've been working on, I guess you could say, a bit of a restructuring of our traditional equity pool. We've made a number of changes recently, including scaling up our position in our new global small cap manager, introducing our CESIS strategy to the mix, and adjusting our weights by manager and by geography. Ultimately, we're making these changes to improve the long-term risk and return profile of the pool. So it's definitely been a busy time.
Thanks, Paul. And because this is a quarterly review, it would seem appropriate to review what's been happening over the past few months. Could we get your take on what's happened in the markets during the past quarter?
Yeah, absolutely. So it was a really interesting quarter, to say the least. Probably the biggest news as it pertains to the investment markets was what's been happening in the banking sector. So at the beginning of March, very few Canadians knew much about Silicon Valley Bank or Signature Bank. But that changed a week later when there was a sudden and unprecedented run on the bank with both institutions that caused them to collapse within days of each other. Silicon Valley Bank and Signature Bank are now the second and third largest bank failures in the history of the United States, smaller only than the Washington Mutual collapse during the global financial crisis 15 years ago. These sudden developments led to panic among a lot of depositors and investors around the world, and many other bank stocks saw levels of volatility that they've never experienced before. So one question I get a lot of is, could this happen in Canada? And the answer is, I don't think we have a lot to worry about. When I lived in the United States, as an example, in the little suburb where our house was, within short walking distance from us were close to a dozen different banks and credit unions. And this isn't unusual. In the US as a whole, there are over 4,000 FDIC insured commercial banks and more than 70,000 bank branches. This industry structure has resulted in a lot of risk being created in certain pockets of the industry as lending institutions compete with one another for deposits. In Canada, say what you will about our big banks, but the relative lack of competition here means that they are much more stable than most US banks. Having said that, the implications of this banking crisis, if you want to call it that, are that economic growth will likely be impacted in both Canada and the US, as well as elsewhere. Already, we are seeing signs that the availability of bank credit is starting to shrink, and that will have an impact on certain companies' ability to grow. Despite the scary headlines, though, investors generally did pretty well last quarter, which might come as a bit of a surprise to some. The Canadian stock market climbed 4%, the US stock market rose 7%, and the technology heavy NASDAQ was up about 17%. And then the Canadian bond market as a whole, which had one of its worst years on record in 2022, climbed about 3.2%. In kind of a perverse way, the problems in the banking sector actually helped stock and bond markets last month. With future economic growth slowing, interest rate expectations have also fallen. And generally speaking, lower interest rates are a good thing for both stock and bond valuations. Now, in some parts of the market, I do think investors got a little too over their skis and bid up prices too much. For instance, stock prices of companies like Tesla, Salesforce, and Meta Platforms, formerly known as Facebook, rose 50% or more in the quarter. So I think going forward, as the economy does slow, investors are going to have to be a little more careful about which areas of the markets they invest in.
Thanks, Paul. Do you think that what has happened in the banking sector in the US is going to give greater motivation now for the central banks to pause on interest rate hikes? And maybe you could also comment on how this might affect the Canadian landscape as well, at least in terms of interest rates.
Sure. Starting with the US, I do think this will help cause the US Federal Reserve to pause its interest rate increases. They might go up another 25 or 50 basis points from here, but I think we're close to a short-term peak in the Fed funds rate if we're not already there. So just taking a quick step back, over the last year or so, the Fed has engaged in the quickest and most aggressive series of interest rate hikes the US has seen in over 40 years. Even though economically North America has withstood these increases fairly well, you can't shock the world's largest economy like that without breaking something along the way. And now certain banks are what's starting to break. Already, we're seeing some pretty material impacts on the credit environment. For instance, in the last few months, total deposits at US commercial banks have fallen over $500 billion from about 17.8 trillion to 17.3. And these deposits are what allow banks to lend. I believe the banking crisis will continue to impact the availability of credit going forward, and tighter credit conditions for households and businesses have no choice but to weigh on economic activity, hiring, and inflation. This, in turn, will reduce the need for the Fed to continue to be so aggressive raising rates. Based on the interest rate futures market, in the last 3 weeks of March alone, investor expectations for what the Fed funds rate would end 2023 at has fallen by almost 150 basis points. In early March, investors were expecting Fed funds to end the year at about 5.5%, and today that expectation is closer to 4%. So as for north of the border, the Bank of Canada already announced back on March 8th that it was holding its policy rate at 4.5%. And that was before Silicon Valley Bank collapsed. So I wouldn't be surprised to see short-term rates in Canada start to actually decline somewhat in the near term, especially if inflation numbers continue to trend in the right direction.
Paul, you've been the senior portfolio manager in charge of Capstone's Canadian Equity Income Strategy, a separately managed account strategy for those over 250,000. Would you like to give us an update on how that's been performing?
For sure. We've been managing client accounts in the Capstone Canadian Equity Income Strategy since October 6th of last year. So we've been live for about 6 months now. I'm always reluctant to put too much weight into short-term performance, but so far we've performed quite well in what has been a pretty challenging environment for dividend strategies. Our model account has returned about 11.2% before fees from October 6th until the end of March. And this compares to the S&P TSX Composite Index, which is the benchmark for the broad Canadian stock market, which is up about 7.6% over the same period of time. So we're about 3.5%, give or take, ahead of our benchmark. While most of that return has come from price appreciation of a number of our stock investments across a number of economic sectors, a good portion of that has come from dividends. Every stock in our portfolio pays a regular dividend, and our portfolio today is expected to yield about 4.5% in dividend income over the coming year.
We know, Paul, that you are involved in the day-to-day management of CSIS, but you are also a member of the investment management team, which is a subgroup of the larger investment committee. So as someone bringing forth ideas and proposals that we vote on, what are some things that capture your attention, either on the positive side or the negative side?
Well, I think maybe I'll focus on the positives. I think one real benefit that does come from all of this volatility that we've seen in the markets recently is that it can provide opportunities for investors who are nimble. I think that Capstone's investment management team has been digging into some pretty interesting ideas in recent months that over time will translate to good risk-adjusted returns for our clients. One good example might be the Global Small Cap Fund that we invested a portion of Capstone Traditional Equity Pool back in September. I think I talked about this manager when I joined you on the third quarter review in October, but this investment manager that we invested with is a new relationship to Capstone. We've known them for a long time as one of the leaders investing in Canadian small cap stocks. So when they launched their global small cap product, we jumped on the opportunity. Since we invested in this fund, it has achieved a rate of return in excess of 20%, which is dramatically greater than its benchmark. Now, I can't say that all new investments that we make will pay off that quickly, but I am confident that some of the ideas that we are currently reviewing will be equally as exciting.
So Paul, this is a go anywhere type of question, so very broad. But what are you most looking forward to in the shorter term? Let's say like the next few months.
So other than warmer days and more sunshine, which I think we're all looking forward to, actually, I am really looking forward to a few different things. Most notably, Capstone is going to be introducing some new investment products for our clients in the coming months. First, we are putting the final touches on the Capstone Kinvest Impact Fund, which will be funding community-based farms in Rwanda. The fund strategy is to purchase Rwandan farmland and then train local entrepreneurs to cultivate, harvest, and export the crops. Over the life cycle of this fund, the intention will be to position these workers to earn a living caring for the farm and to ultimately receive ownership of the farm to have a lifelong economic engine for themselves and their local community. The Impact Fund, it's structured like a private equity vehicle with a 10-year fund term. And we're anticipating our first close by the end of May, give or take. Now, in addition to that, we're getting close to launching what we're calling the Capstone Treasury Pool. This vehicle is a daily liquidity cash-like vehicle that will offer our clients competitive returns through regular interest income. Now, in today's higher interest rate environment, investors are looking for opportunities to park their cash in an easy-to-access, low-risk investment solution that generates much better returns than what their bank accounts typically generate. And we think that the Capstone Treasury Pool will be really well received by our clients. Now, for me personally, as the portfolio manager of our equity income strategy, or CSIS, I'm always looking forward to learning more about different companies and different industries. And I think there will be some opportunities to reposition the portfolio into a few newer names that will allow us to continue to perform well on a relative basis. And then more broadly, as I mentioned, our team here is working on several different traditional and non-traditional investments for our various pools that I am really looking forward to us investing in, because they ultimately will allow us to generate, I think, pretty strong outcomes for our clients.
Hey, great. Thank you, Paul. Thank you so much for your time. We have enjoyed having you so many quarters ago, and it's nice that you were able to join us once again. So thank you very much for your insights.
Great.
Yes, thank you so much once again, Paul. And to our viewers, we hope you've enjoyed our quarterly update. And please stay tuned next month for the next edition of Your Wealth Matters. Goodbye for now.
Bye.